Welcome to the Creating Wealth Podcast, where Kyle Curtin takes you on an extraordinary journey alongside renowned multifamily real estate sponsors and syndication experts from every corner of the United States. We teach you how to harness the power of passive real estate investing and witness the transformation of your wealth building strategy. Let's create wealth together.
This is what I've learned in the process. But
yeah,
there's two different ways that you can invest. If you're going to actively invest in a company or something like that, as opposed to like a fund or a ETFs or anything like that. Like, I'm not talking about any of those because I don't know anything about those. That's not what I've invested in. But the two things that I've done are, one is mineral rights. And so mineral rights is where you're basically, for lack of better, you own the minerals. For lack of better terms, you own basically the land that they're drilling on. And so anything that comes out of the ground, you get paid 25% of the gross on. Or it can change. Sometimes it's 30%. Sometimes it's basically whatever they negotiate. But that's the end result. And you can own it fractionally. You can have, like, I own, I think, 4% of this one, I don't know, mineral rights investment. So I get 4% of whatever the 25% is that comes out of that. That is one way of doing it. Now with going that route, you can 1031 into that, but there's no continuous tax benefits that come from it. There's also no expenses. Like, you're never going to have a month where you get hit with the expenses that come from the drilling or the rig going down or anything like that. It's just, you invest the money into it, whatever comes out, you get 25% off the top. Then the next one is actual drilling operations. And so this can be, in some cases, this could be companies that are going to drill for oil and just create a new well. And then in other cases, it can be where what I've invested in is a small company that will take basically leases that they've had from bigger companies that are no longer producing at, oil is, when it comes out of the ground, it spikes in terms of how many barrels they get out of the production. And then over the course of 18 to 36 months, it tapers off. And then it kind of stays, it slowly depletes over time. But that first 36 months or so is a lot of production and a lot of capacity and a lot of revenue. So some of these companies will then, after that point, like, we don't want to deal with this shit for 10 barrels a day coming out of this thing, so they'll sell it. So these guys will then buy the wells that are, in some cases, because they were producing so little, they don't take care of them. They're not producing anything anymore. And they realize that by cleaning them out, by drilling a little bit differently, or by going to a slightly different depth, now they can tap in and maybe get 10 to 30 barrels a day coming out of them. And so that's one of the projects that I've invested in too, is they've got a bunch of wells that they're basically fixing them up. If you think about like a rental property, like, it's a rental property that's not performing up to standard. They've got to put money into it. They've got to increase the cash flow. And then you get a cut of that. And the cool thing about that route is, if they already have, like, in some cases, they're already producing when you invest. If you're investing and they're drilling, there's typically a much higher potential return, but there's also added risk, because if they don't hit anything, then they've got to re-drill and they've got to do different things. But the other cool benefit of all of it, besides the cash flow being phenomenal with it, is you get a major tax benefit. So you get to write off 80% of your initial investment. Plus, there's other stuff on top of that, but conservatively, 80% of your initial investment in year one.
Wow.
And and it can be written off against, at least from I haven't gone through a tax year after having invested in this yet. So this is just based on what we understand so far, me and my CPA, but it can be written off against ordinary income too, not just against passive income. So that means if you're working a W-2 job and you're making $200,000 a year and you invest $100,000 into one of these, you can write off $80,000 of your W-2 income. So I'm not a tax, all of the disclosures, I'm not a tax CPA, anything. So
yeah.
Run all of that by someone that's smarter than me. But it's super interesting. And the returns that I've seen, like if nothing else improves right now, I actually just got the check today for last month. And if nothing else improves, which they're already doing a lot more than what they did 2 months ago, if nothing else changes, I'm sitting on 19% cash on cash return.
Really?
And it's going to go, yeah. And that's based on them basically producing one truckload of oil every month or selling one truckload every month. And we're already looking at potentially 2 this month, probably very likely 2+ next month. So it's a cool space, man. It's been very interesting to step into and learn about.
Yeah, that's extremely neat, man. Holy crap.
Yeah.
So is there like, okay, so there definitely is like that risk factor of like, if they like drill, like have one of these drilling operations going on, that they don't come up with anything, and that's like, is that kind of like, part of like the initial risks depending on like which part of that environment that you invest in?
Yeah, it definitely is. And even the production capacity that comes out of it, if they do drill successfully, is it going to be, like one of the ones that I'm invested in, or that I'm about to invest in, is they're looking at drilling 4 new wells. They're also reworking a bunch of other wells, 10 other ones. So that's kind of like, in my mind, as I'm getting into this and learning more about it, that's kind of my hedge, is if they're reworking wells and they're already producing some of those, the cash flow from those is pretty good. And even if only a couple of them produce, it produces pretty solid returns. And then if the wells come online and they produce at the capacity that they expect, they're talking, I think it was like 100 to 150 barrels a day initially, which results in a return so high that it's absolutely absurd to say.
I can imagine.
And hard to believe. But it's also, the thing that I've realized with it, and this is why, going back to the wealth conversation too, in this, there's probably a world where I could get out of my investment and make a little bit on what I invested, especially if they're drilling at capacity and they're really cranking out ridiculous returns. But this isn't a wealth play for me. This is I'm invested in this because the cash flow is phenomenal. There's some good tax benefits too, but this is a pure cash flow play to create income. And then if they're even half as good as what it looks like it could potentially be over the next year or two, then that creates more capital for me to then invest in something like real estate, where I can invest, if I invest $100,000 in this, the cash flow will be great, but it'll probably be worth 100, if not less, a couple of years from now.
Okay, I see.
If I invest in real estate, $100,000 is going to be worth more than $100,000 a couple of years from now. So if I'm getting all of my initial investment back within 18 months, then I don't give a shit about not getting a return over the next, like not getting a return on the initial investment, because I'm making cash flow every month that makes it irrelevant. So
that's extremely neat, man. Wow. That's such like a different and unique world, man. That's incredibly interesting. How does, like, in terms of like the length of the investment, is it typically, I know obviously, it'll vary from project to project, I assume, but is it typically like a shorter term, like maybe like a 12 months, 18 months, like a couple of years, or more than that?
Their goal is usually just a long term. I mean, their ideal holding time is 20 to 30 years.
Oh, really?
So,
interesting.
Yeah, because there's the life cycle of most of them it depends on the capacity, depends on, and this kind of starts to get out of my league of what I fully know, but just from the charts that I've seen and that they've showed me of historical production, there's the first few years of ridiculous production. And then when it drops off, like this one that I was looking at, it was crazy returns when it peaks. And then the steady state after that only came out to like an 80% annual return. And that was when it dropped off to, yeah, exactly.
Rookie numbers.
Yeah, exactly. Gotta pump those numbers up. But that's the market, and this one that I'm invested in particular, this is a small company that it's basically a family owned operation. And so there's not exactly, with investing in the drilling operation, it's not like there's a huge secondary market for that. So It's not like I can really go out and sell this. Just if I could maybe try to sell my shares back to them and take a cut on that if I wanted to get it back in the future. It's a little bit different with mineral rights because you actually own the tangible rights to that. So you can go sell them later. And it also, like, that's where it's a little bit different in terms of the one that I invested in is already producing. And there's also, it's a major multinational company that's drilling on it. And so they've got new wells that are in the works and in the plans. And so basically when the new wells are getting ready to come online, when they're permitted, that's a point where you can sell your rights to it, and you'll probably make a pretty damn good return because someone else is buying that soon to be massive cash flow. So that's where there's a little bit more of a resale market, and you don't necessarily have to hold on to it as long. I'm looking at this particular side from the drilling side, though, is more of, it's kind of for the long haul. So
yeah, that's neat, man. Holy crap. So in terms of kind of like vetting the operators or vetting the companies, like if you wanted to invest in something like this, like how would you kind of like start that? You know, I mean, other than hearing of like, oh man, you know, like you should check out this company, like, you know, they've been around for X amount of years, like have this huge track record. In terms of like prior to placing capital with, you know, one company or in one, you know, type of the operation, how do you kind of vet, I guess, an opportunity and like, you know, kind of the operators that are in charge of executing that?
Yeah, it's a really good question. And I will tell you right now that my answer is probably not the answer that most people should ever execute on. But my due diligence was very heavily weighted on the trusted referral source. And so there were plenty of questions that I didn't ask that I probably could have or should have, because I trusted where it came from. And I figured if he trusted them, I trust them enough. And it was also something where I put, you know, this drilling deal that I did, I put $30,000 in there that if it all went to shit, I obviously don't want to lose $30,000. But when I basically had the borrowed credibility from my buddy Paul, our buddy Paul, and knowing that he's a really good human that associates with the right type of people.
Yep.
That plus the fact that it was $30,000, plus the fact that the upside was as good as it was and the downside seemed pretty low, made it so that I felt comfortable with that as a start. And then once I started seeing returns from that, I felt comfortable doing more. From a more technical side, the thing that I dug into, and where I know I could have done more work and probably should have done more work, is in verifying some of the historicals. And that's what I would probably suggest to others too, is I know at least in Texas, you can look at the Texas Railroad Commission. They'll have all the data from these companies on what production has been, all that kind of stuff. So you can validate some of their claims. Mine was also looking at the projections. I want something that's going to be secure enough that I can, like, that's why I'm investing in the ones that are a combination of reworking plus drilling. And so if the drilling goes to shit, if nothing happens with the drilling, I know that the return from reworking those alone is still going to be worth it to me, even if it's only a 14% cash flow. Like that is, that's cool. I'm good with it. Yeah. So that was kind of my, like, I looked more from a financial perspective of the potential upside versus downside, and then borrowed some credibility. But checking the data on, especially if it's something that's already producing, checking the data on what the production looks like and seeing the historicals to make sure that what they're telling you is actually true. And then if it is someone that's drilling basically for the first time, then, if it is a drilling operation, you can check to see, are they drilling for the first time? If so, you can dig into that and figure out how they're doing it to make sure that they're on track and make sure that they know what they're doing. If they've done it for a while, you can kind of dig into their past deals where they've drilled and see their success rate and all that kind of stuff. Or in this case, this is their first time drilling, but I also don't care because everything else that is in this deal that I invested in is worth it if the drilling doesn't work out. So I was okay if that never happens. So again, probably not the best advice for everybody to follow the way that I did. I was a little bit more cavalier than some maybe, but
no, I hear you though, man. You know, and I really like, you know, kind of like the amount of hedges that you did have, you know, and like kind of going into, especially like a new industry like that, you know what I mean? And yeah, no, that's incredibly interesting, man. I'm gonna like start to look into that type of thing, like just to be knowledgeable in it. You know, it's neat. It's so like unique and different, and that is pretty badass.
That's a wrap for today's episode. We want to thank you for being a valued listener of the Creating Wealth Podcast. Make sure to visit www.creatingwealth.com to connect with us. Dive into our ever-expanding library of informative blogs. Get access to our private investor portal and explore a wide range of additional valuable resources. Stay tuned for our next episode as we continue to create wealth together.